following is a presentation of TFNN. The Global Market Pulse with your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Okay, folks, this is Larry Pesavento sitting in for John Logan. Hopefully, we're going to have him back pretty soon. We've been in contact with him. He is getting better, but it's a little bit slower than he had hoped. Anyway, we are going to go down memory lane today. This is a very big anniversary date in the market, as you all remember. Well, not all of you remember. That's been 25 years ago, and that's why I wanted to review my experience of what happened that day, because it was very monumental. I remember the Dow had closed down, I believe, 106 points on options expiration on October the 16th, and I was quite happy because I had October options on, and they expired very nicely into the money, and it was really a very warm feeling, of course, when you have one like that. However, had I done November options, you could have added a couple of zeros to it, but that's neither here nor there. It started Sunday. Sunday, I was in Los Angeles for a wedding for one of my very, very good friends, and also just a really nice guy. He's one of the most important people in financial law in the whole country. He lives up in Seattle, Eddie Horowitz, and he was getting married. He had never been married before. He'd been driving down Wilshire Boulevard about 1 o'clock in the morning, and he passed a lady in a car, and he had a glimpse of her, so he turned his car around. Remember, this is like 1 o'clock in the morning. He turned around and followed her to the little restaurant where she was stopping to get coffee. And of course, she was really scared. Well, anyway, they were both Jewish, and they ended up getting married about a year later, and they've been married ever since. And yesterday was their 25th wedding anniversary. So we went to that. My daughter Jill and I had gone down to Beverly Hills to the Bel Air Country Club, where they had the wedding and reception and everything. And it was really, just really fantastic. There were a whole lot of financial people from all over the country, as a matter of fact, there, and it was really a big event. And we were coming home around 6 o'clock. It took about 3 hours to go from Bel Air up to Pismo Beach, and I was with my daughter, of course, and I dropped Jill off, and then I went back to the office. And for some reason, I don't know why, because we didn't have overnight markets, I just called the overnight desk and asked, what was gold and the Swiss franc doing, because I had a position in, I was short. I still had some short S&P, and that's when the S&P were $500 a point. And I had a position on in the Swiss franc, and I had a position on in gold, and I had a position on in bonds. That was it. And so I got the first indication that the Swiss was up 150 pips, which was just a huge amount, and gold was up $30 an ounce. And I said, wow. And so the next thing I asked, we didn't have overnight futures, of course, so I asked what the Nikkei Dow was doing. And the Nikkei Dow at that time was trading around 30-some thousand. The high had been 39,000 back on December the 29th of 1989. Oh, no, it was on its way up. That's what it was. It was on its way up. It was still going higher. And it was down. It was still around 30,000, but it was on its way up. And it was off about 900 to 1,000 points, as near as I could tell. And I asked the guy, I said, what's the reason for the Swiss franc and the gold? And he said, Secretary James Baker said something about a trade agreement or something like that, and that the mark shook up the markets a little bit. Well, I went back. I went to sleep. Got up my usual time around 5 o'clock in the morning, California time. Markets opened, of course, at 6:30. Remember, we don't have overnight markets. We got the first indication that something really bad was going to happen. Well, really bad, good for us, bad for everybody else, was the fact that the New York desk had alerted everyone that they were going to not be responsible for opening orders in the options pit. And I don't know, what that had. That was from the CBOE, and so I didn't really pay any attention. So I had my program up. I was using CQG for data and everything. And when we got the first quote, across the board, the Dow was down it opened down 300, as I recall. The S&P had closed at around 270, I believe, and it opened at 240. Now, remember, folks, that's 70 to 40 is 30 handles times, not times 50, times 500. And that is an outlier event. And so being the not the cautious person that I am, I went ahead and took off the positions. They went down to 220 that day when the Dow was down 16.5% on the day, and that was the largest down day the market's ever had. That would be equivalent to about 3,000 points today. I can't tell you how scary it was because I've never had a day like this in all my life. I mean, I've had some times that the market scared me a little bit, but not like that. And the reason why is there was no trading going on. The bid offers in the pit, in the S&P pit, were sometimes 10 and 20 handles away. In other words, the offers would be at 250, and the bid would be at 230 or 235. I mean, it was just unbelievable. A $5,000 or $7,000 spread between the bids and offers. And as the market continued to go down and continued to go down, it was getting apparent that there was going to be something really bad happening. Everybody was actually paralyzed. Everybody that I knew was paralyzed. And I had a bond position. And, the gold was working well, Swiss was working well, stocks were working well. And I had a bond position, and the bonds were only down 15 pips. Well, I was so concerned about, them closing the markets that I just closed my bond position, which was really stupid because if you stop and think about it, if the whole world's falling apart and bonds are only down a half a point, what would happen, if things, start to get just a tiny bit better. And that's what happened. Bonds rallied 11 handles in the next 4 or 5 days. I think they were up 4 handles the first day, and they just continued to go. Of course, they were in a big bull market because they had bottomed in 1982. Later that night, what happened was, what's his name? Greenberg, what was his name? Greenspan. Alan Greenspan and Rubin got together, and what they did was they allowed the banks to mark their inventories to the market. In other words, if they had lots of long positions, instead of showing owning JP Morgan at 55 and it was trading at 25, they could put it on their books as 25 to keep the leverage going. So they changed that overnight. That's what turned the market. If you read anything from Greenspan, that's what did it. And so from that point, the next morning on the 20th of October, the market opened slightly lower in the Dow, making a absolutely perfect 61% retracement of the low from August the 9th of 1982, when the Dow was down around 500 and change. That also was a significant day for interest rates because that was a day that interest rates actually peaked, and we've been in a 35-year bull market. Well, I think it's peaked already, but we'll see. Anyway, that's the story of it. Then from there, we chopped around for several months, and about 6 or 7 months later, we finally took out the high in the Dow at 2,800, and it proceeded to go up to, as you know, 18,000 and change. So that's what we're looking at in the market as of the time of October the 19th of 1987. I would highly recommend anyone that has an interest in it to go to Google and punch it in and get some of the articles that were written about it, because it's a very interesting thing. We will have another crash sometime, maybe in my lifetime, maybe not, I'm not sure, but that's what that's what happened. And you don't want to go through something like that. It's an outlier event. They only happen very sporadically, but they do mean something. In 1929, when the market broke, people don't realize this, but the market was trading at 384 on September the 3rd, and then on October the 19th it got all the way down to 200 and I think it was right around 190. Yeah, the market dropped about half, from 380 down to about 190. Then it bottomed, and it rallied from October all the way through the first week in April, where it made almost a perfect 61% retracement. It was like 59.9% retracement back. And then that's when the real bull market started. It was in April of 1930. From April of 1930, the market went from, the Dow went from 260, I believe, to 32 on July the 5th of 1942. Excuse me. It bottomed at the price of 42 on July the 5th of 1932, and then it went up. And it took 35 years for the market to get back to where the high was back in September 3rd. So you can go through these long periods of consolidation. So just keep that in mind. We had the same type of thing happen in 1974, or market topped in 73. But from 1970, when the Dow first hit 1,000, it hit 1974, it hit 1,000. Then it went back down to 500 again. Into 1982, and it wasn't until I believe 1984 that it finally took out. It was in that long-term consolidation for 10 years before the Dow took out 1,000 again. So we live in interesting times with the interest rates where we are there now, and with quantitative easing. It's not surprising that we're here at 19,000 in the Dow. So that's the history of what we're looking at. We're going to be up for a little break here, and then I'm going to go into some of the market things. We've hit some really critical Fibonacci spots over the Friday. So we'll take a look at those when we get back. 877-927-6648.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Eddie Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and this is Larry Pesavento sitting in for John Logan. I wanted to share a chart with you of options expiration day with the OEX, and if you'll take a look at this when you go into Tiger TV, you'll see over the last the last 8 times we've had options expiration, you'll notice that each time after that the market sold off. That's 8 for 8. That's a pretty big, unbelievable thing. You know, if you try to flip a coin 8 times in a row, it might take you a week to get that done. But this is a very unusual situation, and that's what we had happening on the 16th on Friday. Was interesting because when we were on the floor of the Money Show on Thursday, I was right at talking to Tom and Tommy in the kiosk, and I was watching the S&P 500, and it had just backed off to a perfect 61% retracement at 1990 on the day. It was making a beautiful little Gartley pattern right there, and I said, boy, this market really wants to be bought here in the last hour. And of course, I'm far away from a machine of doing anything, and I don't do those when I'm traveling, but the market just took off and ran 30 points. And when it did that, it destroyed that 4-day area where the S&P cash had not been above the area of February of I can't remember the date, September 17th, and that happened on Thursday the 15th. We did take that out, and then the market was a little bit higher again on the 16th into options expiration right at the very end, where it also rallied 15 points in the last hour of trading. It makes one wonder who's doing all this. Anyway, we'll see what happens with it today. We come into a very overbought situation, but we do have one pattern that is, of course, one of my favorites, and that is a Gartley pattern that we have forming here in the New York Stock Exchange Index. We are just a tad above the 50% retracement, and we are making a perfect AB CD pattern. I did the actual calculation on this just to make sure I did it right, but the ABCD measured to 10,422. The high for that day was 10,424. Looks like we'll be maybe a tad lower today. We'll see what's going to happen here, but that is a perfect Gartley pattern. Gartley said in his book, Profits in the Stock Market, from 1937, that the best trade that you can have is to let for the market to make a top and sell the first ABCD correction in that bear market. The same thing, the opposite, is true of a bull market. So this is what we're looking at right here. We have just a lot of things going on in these markets, so we've got to pay very close attention because of the price levels that we're hitting. Now, last night in the NASDAQ futures, we were up about 15 at one time, and we were able to take out the highs of February 17th by 2 points at 44.44. The old high had been 41 and a half, and after it did that, it stayed there for a good half hour, and then it started to sell off. The DAX, the German DAX, had been the strongest of the markets, and that was the thing that pulled the market higher, because the S&P and the NASDAQ and the Dow had opened a little bit lower on Sunday night, but when the DAX came out and started to trade, it opened a little bit lower and then just ran 120 points, which is a considerable amount, versus the S&P, and it took it up to 10,200, and then that rallied everything else. And then, of course, the DAX has sold off a little bit since that time. The reason for all of this, supposedly, given the information that I had listening to Bloomberg this morning, was that the news report out of China with their GDP at 6.9%, the lowest since 2009, was actually less bearish than they were expecting, and so they interpreted that as being bullish, and that's what it did. And who knows, that's what it could be. We don't know for sure. We want to watch that, with a little bit of care, I would think. Now we're going to take a look also at some of these other markets that are involved, because there's some divergences here that if you're bullish, you should be aware of, and if you're bearish, you should be aware of them. As you'll notice here, the IWM, the ETF for the small cap, also has rallied back to a 78% retracement of the high back on September 17th. Take a little break here. 877-927-6648.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and I'm going to put up a chart of the VIX index, but frankly, I'm going to let Basil give you his description of it because it certainly is far better than anything I've seen in the business, and I've been doing this for quite some time, so we'll let Basil cover it. But I'll put the chart up because we're in an outlier event. We're down, I think, 12 days from that little minor high we had back on September the 28th. It's incredibly oversold, and there's just absolutely no fear in the market at all, and just exact opposite of what was going on here 25 years ago, of course, but that's what show business is, folks, so we'll take a look at it. All right, we looked at the IWM to show you that it was diverging quite a bit, and remember that had been one of the big movers of this big bull market. We also have another one that was able to take out the August lows. Both of those took out the August lows without very much trouble. And I need to, I've lost something here. What have I lost? There we go. I want to get to the banking index. Give me 1 second here to get to it to show you the banking index also made new lows. That was mainly due to the movement in J.P. Morgan, and now we have Morgan Stanley is under trouble. We had Goldman Sachs on Thursday. Goldman Sachs was one of the reasons why the market turned, because Goldman Sachs had some bad news. It opened at down about $4 in Goldman Sachs, down around the 175 level. We were actually in a trading room at that time, and it was really unbelievable because not unbelievable, but it was making a perfect Gartley on a 30-minute chart, exactly at the 61% retracement at 175. And someone next to me, a trader, they said, gee, this thing looks like it wants to be bought. And I said, well, it's in an up market and it's a Gartley, it's a buy. And sure enough, the stock ran 10 points. And that was the day that the market, had the Dow down 50 to up 220 in the last, hour of trading. People ask, how can that happen? It's very simple, because once a market starts up, it can do it with lack of selling, folks. The bids just start rising. And that's how it goes. If they want it, they're going to have to pay for it. And the shorts just, increase their offers, and they increase their bids, and it doesn't have to be a whole lot of volume at that point. So that can happen. It happens all the time. And many times you see the market, respond very, very nicely to bad news. And also it can respond, really poorly to good news. Remember that. Now we want to take a look at the breadth, because we've had, a pretty good change in advanced decline line. Even the new highs to new lows has, given some signs that there's still life in this market. So this has happened in a matter of about 8 trading days. And that's the way it is now. We're quite a bit overbought now in the advanced decline line. We didn't do much as far as turning the new high to new lows, but the advanced decline line has went back to areas where we haven't seen in quite some time. So that just means that the market is considerably overbought. That's the primary thing. Now we've got to take a look at something that I think is extremely important to us, folks, at least from the perspective that I've looked at, and that is the gold market. Because if you'll take a few minutes and look at this gold chart, it really is a beautiful picture of Fibonacci in action. If you can see it, for the past year, we had November of last year, we had a $170 rally. Then in May, we had a $70 rally. Then in August, we had a $70 rally. We had another $70 rally that turned out to be a $120 rally. And all you have to do is take your little calculator out and write those 4 numbers down: 70, 70, 170, and 120, and just play with the Fibonacci numbers, and you'll see that each one of them is a perfect Fibonacci expansion or contraction of the 0.618, 1.618 relationship. So this tells us that we've completed this ABCD here in the gold market up here at 1192. We backed off about $20-some since that time. Remember, the first good correction should be $34. That's the harmonic number in gold, is 34, also 17, but $34 from 91 would take you down to about 70, right around, 31, 75. I got to do this in my head. 91 and 3, we 67. You'd be looking at around 31. No, that'd be 30, would be 67, would be 57. So you'd be watching it around $57 an ounce. 1157 an ounce would be your first spot where you'd want to be watching for support to come in. This is only the second day down, and so you'd want to be looking for about a 3 to 5 day correction in the gold market. I will say this, that if we clear 1192, 1195, this market is going to really go because it's got legs, because we've had some good increases in open interest recently. What we're going to find out now is how much power the bulls really have on this retracement that we're happening. It might only be a 2 or 3 day retracement, and then we take off from there. I don't know, but right now it is in a bearish mode. It will stay that way until we take out 1192. That would be equivalent in the silver market at around 1620. That's what we hit in the silver. We didn't quite make the 61% retracement in silver. If you'll take a look at the chart going back over that same time period, you'll see that silver rallied $4 an ounce back in December. Then the next time it rallied back into May, it rallied $2.50 an ounce. And if you did the 250 into 43, you'll see that was 61% of the rally from January. And then we did 230 into 250, and that's basically a 1-to-1. We didn't make the 61% retracement on this last move in silver. We only got to 16.19. Actually, we should have been 10 cents higher up to the 16.29 level. That would have made it perfect to the one from May, March to May, and also from August to October. But that didn't happen. I missed it by 10 cents. That's, these numbers are so accurate, they're surprised when they don't hit it perfectly. Gold hit it perfectly, so we'll just have to, keep an eye on it as it's moving. Here again, if we get above 1630 in silver, these things could be off to the races. Now, you don't have to have any particular reasons why these happen, because it's just chart action that you're looking at. You don't really, don't really have to worry about that. You just determine what the chart's doing, because if there's more buyers, prices are going higher. If there's more sellers, prices are going lower. It doesn't make any difference what the news is. You saw that in Goldman Sachs last Thursday, the S&P on Friday. And by the way, I don't know if you follow this, but over the last 11 times in the last 11 Fridays, the market has rallied very strongly in the last hour of trading. So that's something to watch on Fridays, because that's what's really happened. Now, I would like to go over one other major market that has really shown some a little bit of weakness here compared to the rest of the market, because it had been a leader on the way up, by far the leader, and that is the biotech index. We've been in a 3-week rally now, and we've barely been able to get to the 382 level of this move, whereas with the S&P, we've gone to above the 618. The Dow Jones made a absolute perfect 61% retracement on Friday, folks. It was right on the money, and fact is, I would like to show you, because I did the actual hand calculations with a calculator, and I had to find one, believe it or not. Everybody uses the computers. But from the high we made on May 19th, when we had the new moon and Mercury retrograde, when we had Norm Winsky on, you'll notice that it made a perfect 61% retracement here in the market on Friday at 17,217, and the high on the Dow was 17,220. So as long as that's not taken out, we should be right into a zone where we're looking at something very scary, possibly. And if you notice this chart here on the Dow Jones Industrial Average, it's also the yellow triangles that you see. It's also a 3-drive pattern, but it's also the 1, 2, 3, 4, 5 expanding triangle. And that is one of the more bearish patterns in technical analysis, because you have so many numbers to work with. The problem is when it fails, it can really go. So anything above 17,260 in the Dow tells you you're probably going to go all the way up to 17,000 and change. I don't think we have started a new bull leg. In fact, I think we're getting close to starting a new bear leg, but I want to give it a day or two. Last week, I wanted to see the market back off, which it did, and it only backed off for 2 days, and then it took off and rallied. We've had a question about the Dow Jones transports, and I'll put that up and let you take a look at it because it's still in the downtrend. We've had lower tops here ever since July. We've had some really big up days and down days, but it's never followed through by very much. And then Friday, we did have the Dow Jones transportations was off quite a bit, given the fact that the Dow was actually up. Remember, the Dow was only 30 stocks, folks, and they're weighted by price. So when you got a stock like Nike, and you got a stock like Disney, stock like IBM, they make those things jump up quite a bit. You don't need very much to get it moving, and so that's the one that you keep in mind when you're watching that, because this whole rally has been done with 531 stocks, the 500 S&P stocks and then the NASDAQ stocks, which are also included in the S&P. And then you have the 30 stocks in the Dow Jones. So that's really where this rally comes. In the New York Stock Exchange Index, there's 2,400 issues of the most widely traded and active things in the whole world, and that hasn't done nearly as much. It's completed a perfect Gartley. I mean, it's the perfect ABC number 10,422. I think you have to give that a little bit of weighting when you're watching this. And when you stop and think what happened, to the Nasdaq. See, the Nasdaq was only able to make a 78.6 retracement again, and it took out the February 17th high last night. And I checked; it was around 5 in the morning, New York time, and the old high was 44.41, and it made 44.44. There was absolutely no buying there. There were only a few trades up in that area, and then immediately was trading below 44.39, and from that it dropped 20 points pre-market, but it's still very early. And these are just numbers. They can be shattered today, without any trouble at all, and the market continued to go higher. It can do whatever it wants, of course, but we are looking at some pretty significant divergences. The most important thing by far, from my perspective, is the fact that New York Stock Exchange Index was just absolutely spot on ABCD, and the Dow Jones spot on exactly 0.61% retracement. If we go back and look at the previous times we've had, give me 1 second, folks, just about 2 seconds here. Okay, if we go back, and I'll post this up. I posted it before, but I wanted to add something to it. If you'll notice those, when we've had these, there's that expanding triangle again. It's called the reverse point wave, or symmetrical triangle. The little red arrows are the 3 drives. It's 1, 2, 3, 4, 5. Those are the waves that you're looking at. Each wave is higher than the other. But if you notice those red arrows, those are the arrows where the market topped, and then you'll notice right after that there was a retracement. Now on this particular chart, you'll notice we have on August the 25th, we broke down below the previous year's lows. We did that. We took out the 2014 lows. That's only this is when this has happened. Then you notice each of those times in 2001 and also in 2008, we had a rally back. The one in 2001 rallied back 78%. And then the next one in 2007, that happened on October the 7th of 2008. And that put the market in at, no, excuse me, it wasn't, the high was on October the 7th. The intermediate high came in around July, and that was a beautiful ABCD pattern at a 61% retracement. And now we have the New York Stock Exchange Index is now at an ABCD level at a 50% retracement. So if I read the chart correctly, this could be actually a weaker market than either of these other two, because it's only been able to make a 50% retracement, where the others were able to make either 786 or 61%. But this is still too early to tell. We won't know that unless this is really correct until we have a couple of really strong down days, and then we'll have a better idea of what's happening. Okay, we're going to take a little break here. We'll come back and finish up the show. 877-927-6648.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Okay, we're back, folks, and this is Larry Pesavento for John Logan, and we've got one of our favorite people on the line. Everybody's a favorite, but someone real special. John, how are you?
Good morning. To be frank, I'm not that special.
Well, you are to me, so that's important.
Well, likewise. I wanted to call in and thank you. Last week you had a couple of programs in which you shared some of your personal history, experience in the markets. From a historical perspective, I just find that incredibly helpful as backgrounder. And to tie things into the present day, Your text, Patterns, Profits, and Peace of Mind sits right on my bookshelf. Actually, not on my bookshelf, right on my trading desk. I'll refer to it, a couple times a month just as a refresher. And with that in mind, I want to alert you to this. The wheat markets. The wheat market has been in a major bear market. The Minneapolis, Kansas City, and Chicago contracts all made new bear market lows in the August-September timeframe. And if you look at those monthly charts, you can see how we've come way down, possibly into support, possibly with three drive to bottom patterns. And we've had a rally, 460 up to about 530 on the D-Suites. And right in your Patterns, Profits, Peace of Mind text, there's the idea of trading Gartley patterns, a first pullback in what appears to be a first rally leg. I wanted to alert you and your listeners that I believe we've got that set up right here, right now. Don't know if the trade will be a winner, but just to let you know, I purchased it here at 488, risking 10 points. Mm-hmm. And if this is a Gartley buy pattern, and if we get an ABCD up, that gets us up to 550 or so. So just wanted to alert and share that with you.
Well, John, I've posted the wheat chart with that Gartley pattern into the room, and I can see what you're looking at. You're certainly right at the moment of truth right here. The thing is that, 10 cents lower is your 786. So usually when I do something like this, I don't like to rip because this pattern is so nice. If we get much below 483, I would take this is the way I would do it, is I would take a small loss in that at the 483 level and then rebuy it at the 478. Because if it starts down, we both know that it has a high propensity to make that 786 level if it breaks. So you're right. This is the lowest risk you're going to get in wheat. And longer term, I agree with you. Both wheat, corn, and beans, they could have a pretty good move from this level.
Terrific. I thank you for sharing that fine-tuning of the tactics. I find that very helpful. So anyway, just had to share with you what I see as a real-time example of patterns you look for. So there we are, and thanks so much. I appreciate all your efforts.
You bet, buddy. And we enjoy you here coming in and showing us what you're doing with your trades and everything. It's a huge help, and all the information that you share, everybody really loves it. So keep it up the good work.
Excellent. Great. Have a nice day.
Thank you, John. Okay, folks, we've got to wind it up here. Keep in mind that the New York Stock Exchange Index made a perfect Gartley ABCD as of the close, 10,421. If we close really strong today, all these patterns will have failed, and we're probably going to go a lot higher. The Dow Jones made a perfect 61% retracement at 17,220. And these numbers are Fibonacci numbers. They don't work all the time, but they work more than they fail. So keep an eye on them and keep your rear view mirror clean. Live every day in an attitude of gratitude, and may God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.